So moving averages are by far the most commonly used indicators out there. We see them on social media. People build systems with them, moving average crossover systems or pullback systems. We also see them a lot even on the mainstream medias. You'll hear the S&P 500 has broken its 200-day moving average and what that means and all of this. But most of the time you hear what price is doing related to that moving average. What I'm going to talk about today is maybe it's not the position of the price relative to the moving average, but the slope of that moving average. So let's get into it here. So this is an article I wrote over the weekend where essentially I wanted to prove this idea that maybe we shouldn't be looking at where price is related to the 200-day moving average or whichever one you use, but in fact, we should be more concerned with the slope of that moving average. If you're interested in reading the full article, link in the description below. You can also sign up for my newsletter there. I just Every time I have an idea, I write something, I send it out. I never share it or sell it with anyone, so don't worry about getting spammed. Now, the idea was simple. If I took a very basic trading strategy, one that's used very, very commonly, and then compare that to what it looks like base, what it looks like if I care about the position of the moving average, and then what it looks like if I care about the slope of that moving average and see which produces the best equity curve. So if we take a look at the top box right here, and we just say, focus on this one, and we say, okay, what would happen if I use a simple MACD crossover, which again is just two moving averages smoothed a little bit funny, but basically one moving average crosses above another, I buy, the moving averages cross back down, I sell. What does that look like? And I went back 27 years, and this was the performance. Now, pay attention to these numbers. We have 80% net profit and a 41% drawdown. So that means at some point you would have had to be sitting down 41% or about half of your account down on a system. Now let's just take that moving average and add it in. So in this case, I added in the 200-day moving average. And I said, okay, we're going to do the same thing. We're going to say I will buy when the MACD crosses up and I will sell when the MACD crosses down. But I'm only going to do that if we are already above the 200-day moving average. This is something that is used all of the time. Again, that's the one you'll hear about on CNBC and all of these different things. So the first one, you can see the net profit increases ever so slightly. It goes from 82% to 90%. So you gain 8% more over your 27 years of history. Your drawdown remains pretty much the same, within rounding of what it was before. So you're still sitting through that massive drawdown. You're not making much more money by adding this to your system. But let's go through and let's add down here on the bottom. Let's say I'm going to do the same thing. Again, MACD crosses up, I buy, MACD crosses down, I sell, but I'm only going to do it when the moving average is sloping higher. And by sloping, I mean just that. I mean that the price of the the price of the 200-day moving average is less than it was a couple bars ago, just showing that the moving average is sloping higher. Now, in this case, you can see we over double our gains. So we make 179% return, where before we were making about 80 or 90. And more importantly, we cut 10% off of our max drawdown. So we make more money. We have to sit through less drawdown. That just seems like a win-win. But if we zoom into the equity chart, we notice some really cool stuff. So first of all, 2001 to about 2003, the system sits in cash. And if you know what happened in 2001 in the market, you can probably understand why. We had the tech bubble burst, everything pulled in, and we had a period of time where that moving average would be sloping lower. There'd be all kinds of turmoil in the market. It would be a good time to take this system and maybe shelve it, and then maybe take another system that moves a little bit more frequently and say, okay, now we're going to then now trade this shorter term system while this longer term system does nothing because the markets are a little bit too crazy. Now, again, you can see 2008, 2009, during the great financial collapse, the same thing occurred. The system moved to cash because all of the moving averages were sloping lower. No trades were made. And again, you could have just stayed out of the entire great financial collapse, which would have been amazing, or you could have implemented other systems that time. And we are back in that system right now. So it would have happened about I believe about the beginning of 2022, give or take, is when that moving average started to turn down, and it was time to make sure that we were in cash. So all in all, again, I'm not trying to convince anyone to use this system. I don't think it's a very good system to use, but the idea is how we can make a system incrementally better by adding the slope of a moving average to that system in order to determine trend. So if you're interested in this and you're a system builder yourself, or even if you're a discretionary trader and you want to do a little better job at, refining your trades, maybe making a little bit better decisions, maybe go and look and say, okay, well, what would happen if I removed all trades that were below a downward sloping moving average? Or above an upward sloping moving average? Am I fighting the trend one way or the other? And a very common one, again, show it to Brian Shannon. He always talks about his 5-day moving average. If it's sloping down or if it's sideways, he doesn't really take a trade. He only wants to take trades above and upward sloping. Now, one more example here, and this is just simple chart analysis. So say you're not a system builder like myself, and you just want to focus on how I evaluate charts. Well, say you're someone who trades simple flag breakout charts. Well, here on Zoom, you can see there the moving average started to slope up actually pretty early. This is the IPO date on Zoom. And you can see we had a little base and then a breakout that was great. Then we had a larger base and a breakout. And again, it was easy to buy these breakouts each and every time that you had an upward sloping moving average. There was a couple nice breakouts. Even if you bought some of these breakouts, things went okay. The moving average flips kind of in this area. You can see it flattens out and then it starts to move lower. If that was your cue to leave it alone, if you're someone who doesn't like to trade short, or to start shorting and not buy breakouts to the upside, but starting to buy breakouts to the downside, you can see now that the moving average is sloping lower. Anytime you took a breakout to the downside, that would have been profitable. Anytime you had tried to take a breakout to the upside, you would have had struggling ways to fight trend. So again, if you're a systems trader, whether you're a day trader or a swing trader, or if you're a discretionary trader, day trader or swing trader, try to find a moving average that may work for you. Implement this rule in your trading. Maybe you can cut out a number of trades that are holding you back. Might be that little edge to get profitable. So if you want more of this content, subscribe to the channel. Use the link in the description below to sign up for the email letter. Follow me on Twitter, just Michael Nauss CMT. I hope this kind of content can help you with your trading journey, can help put a little bit of edge in your favor. Thank you very much. Have a good day.